My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make some money. My job is not just to entertain, but to explain what's going on with this market. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Things got too cheap. Many stocks just went too low or turned out to be too low versus the numbers they ended up reporting. And that's why I wouldn't be surprised if we've got more room to run, even as the market took a breather today. Dow dipping 57 points, S&P declining 0.20%, NASDAQ inching down 0.07. We're overbought, and we can expect some profit taking. Sell. There's been a lot of money made very soon. A breather's warranted. Often when we've had big runs like the one over the last 4 weeks, it's because, though, something actually has changed beyond sentiment. Now, look, you can always have too much negativity and get a snapback rally, but that is not what's happening here, people. We're dealing with a market that was too punished versus the actual fundamentals, and it's worth examining how that happens. I think it holds the key to the next phase of the rally. First, I don't want to minimize the fact that interest rates sure look like they peaked in late October, and the Fed might be done tightening. We're doing a week-long series on what works if rates have truly peaked. And if the recent action in the bond market reverses itself, well, it's true. They'll move this. Let's say it becomes suspect. But if you take interest rates out of it, you simply cannot have such a powerful move as we've just had without something changing in the real world with individual companies' prospects, not just in the animal spirits of the market. So let's go over the things that mattered and the things that changed for the better. Why don't we start with Exhibit A, the $1.1 trillion company that is Nvidia. CEO Jensen Huang worked for 20 years to develop graphics cards that could be used to generate thoughts, to actually think for you. For a couple of years, even as it amazed those who saw it, like we did, the technology, it went begging. And then a year ago, we found out about this ChatGPT from OpenAI. Jensen worked with Sam Altman from OpenAI for years. He was ready. He had the supply of chips. He had the ability to make more almost endlessly, and he could sell them for big prices. Last year at this time, we thought Nvidia would earn around $4 per share in 2023. Instead, thanks to the power of AI and the demand for all those chips, do you know they're going to earn maybe $12 per share? While stocks can go up because people are willing to pay more for the same earnings, that's what we call multiple expansion. We prefer when they go up because the earnings turn out to be much better than expected. Nvidia is experiencing both kinds of rallies, but mostly it's about the huge numbers. Why should we care? Because ultimately, we don't want to pay more and more for the same earnings, right? When that happens, they get more expensive and they get risky. We want stocks to turn out to be reasonably priced based on higher earnings because that kind of rally is sustainable. And that's why I say that even after Nvidia stock has advanced 230% this year, the best performer in the S&P 500 is a stock to own, not to trade. When you consider how much Nvidia could make, it's actually cheap on both current earnings and future estimates. Ben writes this, who's a very good analyst over at Melius Research. He points out this morning that Nvidia is trading at just 23 times next year's earnings, 20 times 2025. That's well below most of the Magnificent Seven. It's cheaper than Microsoft, cheaper than Apple. And Nvidia is just one example of a company that's growing just bonkers for actual earnings, thanks to AI. Same goes for Microsoft with its Copilot AI platform. It's a product that you pay for separately from your current Microsoft software. It is already being viewed as indispensable from many of the sources that I talk to. Adobe's using AI right now, making a profit with it. May not be included in current earnings estimates. They could be going higher. Many others might follow with actual raised earnings from AI. I think ServiceNow could. Again, I'm just trying to drive home the point that at this moment, last year, we had no idea that this thing could be happening. None. This tangible thing that would lead to huge increases in earnings and earnings estimates for so many companies. If we were just paying more for Microsoft because we loved Microsoft, then those gains could be illusory because love disappears very quickly, doesn't it? Multiple expansion equals love. Paying for higher earnings equals rigor. We have rigorous projections for AI. Of course, not all tech's moved on AI. For 2 years, we had a glut of PCs, as so many people bought new computers for their home offices during the pandemic. We're now almost through that glut, which has led to steady rallies in the stocks of AMD, Micron, Intel, all the semiconductor capital equipment names that help produce chips for them. It's a huge upcycle, and when it works big. Bye. Right now, it seems as though these semiconductor rallies are driven by multiple expansion. But when we see the numbers for these PC-related companies next year, I think it's going to be like an Nvidia situation, where the stocks turn out to be much cheaper in retrospect, because the earnings for those companies I mentioned, I think those earnings are about to soar. Then there's another group of stocks that's been hurt unnecessarily, but are now free to bounce back. The food plays. Not long ago, there was this fever, the fever from Novo Nordisk and Eli Lilly's new weight loss drugs. Managers dumped every food stock, every beverage stock. There'd be massive adoption by these new drugs, something that could happen over time, but not anytime soon. Now, they knocked down the whole food and beverage cohort, and I think they've created some bargains. Today, we got to upgrade the stock of Mondelez, the snack food maker. Now, I think we've realized that these new drugs won't immediately turn the world upside down. The food company stocks, they've gotten too cheap. The beverages are too cheap. Even the alcohol, too cheap. Even after this recent bounce, which was made, of course, by the fear of the GLP-1s, not the bond market. That's the name of the class of drugs. You know, we own Eli Lilly for the charitable trust, even up here. And we tell club members, because although we don't expect the demise of the processed food industry, we do think Eli Lilly's drug, called Mounjaro for diabetes and Zepbound for weight loss, will be among the best-selling drugs of all time. But get this, if I am wrong, Lilly stock is way too high. Sometimes what you have to do is you would need to make a bold move. Not a gamble, but a bold move if you're trying to make big money. We are making a bold move by sticking with Eli Lilly. What else? Coming into the year, Wall Street figured that higher mortgage rates would just annihilate the housing stocks. They, too, experienced a gigantic dip when the Fed continued its relentless campaign of rate hikes. But as it turned out, higher rates didn't do much to damage their profitability. Because we have a major housing shortage in this country. They can't put them up fast enough, and they can charge pretty much what they want. The homeowners didn't need to cut prices like we thought they would. And these stocks ended up being very cheap. Now, housing punches above its weight. It's only 10% of the economy, but man, can it play a big reverberation role. Now, there are whole cohorts that we still aren't sure about, and these are going to be what we have to count on for the next leg, okay? Earnings for banks, underwriting's picking up. I don't know. Mergers, not so much. Healthcare stocks can't get out of their own way. Is that politics? Medcare? I don't know. Or will they look back and say they were cheap? I don't think so. Energy stocks, crush. Makes sense. Gasoline's been down for 60 straight days. Retail stocks, incredibly weak. Again, though, perhaps that's just Amazon doing its Grim Reaper thing, crushing the earnings potential from its bricks and mortar competitors. If earnings don't grow, these stocks won't go higher. I bet Amazon will have much higher earnings, though, and you should stick with it because it can keep delivering upside surprises. Do you think we can keep going higher from here? I think we've reached our limits on paying more for this set of earnings from tech. Same with the food and beverage stocks and housing. Those are big chunks for the market. They got us here. If we're going to go further, another group will need to turn out to be too cheap, which will be the industrials, maybe the autos, the travel and entertainment. There has to be a better earnings story out there that we just do not know yet, bottom line. This market needs some new heroes to go higher, at least one, ideally more. Otherwise, we're going to lapse to that pure multiple expansion thing, which makes the market get more risky than I'd like. Doesn't mean it can't keep going up, but it does mean the rally from here would be a lot less sustainable and, yes, a lot more dangerous. Let's go to Alden in Oklahoma. Alden.
Hi, Jim. Thanks for taking my call.
Of course. How can I help?
Well, I had a great experience at Best Buy in Tulsa recently when I bought a new cell phone and accessories I added, and they were just phenomenal with me. And I left the store not only elated with the right cell phone, but I had bought a $49.99 extra plan from them that would enable me to have flexibility on returning the phone. Turns out I got all these perks, and the marketing, the store, the people, I was just blown away by it. And
well,
I wanted
you
to
should
know
be.
What you thought of the company.
Okay, hold on. I got to tell you, when I saw the earnings last week, I actually liked them. And I think the world of Corey Barry. She should come on the show. We'll do the show from a Best Buy. I agree with you about that. It's an inexpensive stock, and it yields 5%, and I think you should be a of that great one. Austin in Pennsylvania. Austin.
Booyah, chill man.
Yo, what's happening?
Now, I'm a proud Costco member. I mean, I just got gas for $2.87 a gallon, so I'm pretty pleased. But I've been holding this stock for a while, and the company's nearing its all-time high of about 600. So I need to know, is Costco as strong through 600 as Jake Elliott's leg?
Oh, man, that's a miracle leg you're talking about. I mean, you're talking about, I don't know. But I tell you, I think Costco could hit a 64-yard field goal in the rain. That's what I like. All right, the market needs some new heroes to go higher. Otherwise, we're going to lapse into pure multiple expansion, and that could be unsustainable. On Mad Tonight, Wix has had a nice move over the last month, along with the rest of tech. So is the company that spent much of last year in the doghouse ready for a sustained move higher. I'm getting the latest from the CEO. Then, if you think that interest rates have peaked, where should you be looking in this market? I've got the answers. And Microsoft Security Business has 15,000 partners backing its $20 billion operation from within. So I'm learning what's behind the Juggernauts division, the company's corporate vice president for security. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.